Breakfast Grille this morning is Teng, CEO and Portfolio Manager at Hwang Investment Management. Hwang is one of Malaysia's largest independent investment management houses with over 20 billion ringgit of assets under management. It was recently announced that Affin Holdings had won a final bidding round for the right to buy into Hwang. Can you give us an update on the status of this deal?
The group has announced that Affin has entered into an exclusive arrangement to buy two entities in the group, the investment bank, the asset management, and underneath the futures and Aiman, which is the Islamic asset management. The deal is now pending Bank Negara's approval, and subject to Bank Negara's approval, if that comes through, then by January next year, these entities will be part of the Affin Group.
Now, recently, RHB paid about 1.8 times price to book for OSK. Will Hwang get those sort of valuations?
It's difficult for me to comment on valuation at the moment because that has not been disclosed to the public. I think each entity commands their own premium and valuation. Really depends on how the buyers would like to maximize the values that the group carries with it. At this moment, it's premature for me to comment until the information is made public. Then let the public judge what will the pricing be like.
Did Affin win the bid on a best price basis, or were there other considerations like how good the fit between the merged entities would be? For instance, AMMB was also a part of the race.
Obviously, when the owners came together to put up the group for sale, one of the other considerations other than pricing had been the fit of the staff into the new entity. Bear in mind, this business has been built up by the late Dato' Sri Hwang since many years ago. And the pledge that the shareholders had for all employees is that it's just not about pricing, but ensuring the continuity of the late Dato' Sri's legacy. So definitely when the bidding was going on, there were consideration of how each of the different entities can fit in together.
What kind of challenges do you expect as part of the integration process? Would there be significant headcount reduction, either on the Hwang side or on Affin side?
I think if you take a step back into this particular transaction, for the asset management, we are not looking at reducing headcounts. We are looking at it from the perspective that from a very independent fund house, Hwang will then be a bank backed by Affin. There will be a lot of opportunities for us to explore beyond just what we are doing today. If you look at our portfolio, there are still gaps that we can cover. For instance, into the government agencies, into the state agencies. These are areas that we have not been strong in over the years. And I think under Affin, together with the backing of the bank, we can definitely explore and expand further. Another areas that we are hoping to develop over time is a greater footprint, not just in Malaysia, but in other parts of Asia. And again, this will require capable people that we can develop within Malaysia to help us expand those footprints. So we are not looking at really about cost cutting or efficiencies in this particular merger alone. We are looking at how to maximize our positioning and looking at growth over the next 5 years.
A quick glance at Morningstar reveals that Affin funds have not performed very well when compared to competitors. What kind of plans do you have to improve performance at Affin?
We will have to take a look at our portfolio of funds, Affin's portfolio of funds, and see how to integrate the products. Clearly, there are gaps at Affin in terms of their performance, and we will try to help them improve on the performance through using Hwang's investment process. And subject to shareholders' approval, some of the funds we may want to change the mandates to make them more diversified and more applicable to current trends. So there will be a lot of work to be done in terms of integrating the funds, and definitely one of the things that we like to achieve is to help Affin bring up their fund performance.
Can you tell us about the scope of Hwang's investment? Because as we understand it, the acquisition involves the investment bank and the investment management units. Tell us a bit about what your operations are.
Investment management today, we have assets over 24 billion RM. We have grown the last 9 months despite the uncertainty of our shareholders wanting to exit the business. Our clients have stuck with us over these last 9 months. We have not seen major withdrawals of funds from the entity. And as such, we are glad that even our staff, they have stayed over the last 9 months. We have not seen major people, key people leaving us. Like most M&A activities, you will find that people will start to leave, clients will start to leave because of the uncertainty of the direction forward. For us, we are very happy and glad to say that over the last 9 months, despite all the uncertainties, we have grown our assets by 20% from 20 billion to 24 billion. The key staff have stayed on in the last 9 months, and our clients have stayed on, and we have even won additional mandates over these 9 months. I think going forward, what we like to say is that as part of the Affin transactions, the key management of the asset management will still be staying behind to run the business, to help Affin build the business further to new levels. We are committed to it, and there is also in place incentive plans to keep the key management staff intact over the next few years.
Press reports often talk about market shares of stockbroking operations, and one report highlights that the acquisition will bring the Affin Hwang entity one step closer to being the third largest stockbroker with a 9% market share. Why does stockbroking size matter, given that broking commissions are falling rapidly?
I think generally that's how the market measures stockbroking, through volume. But I tend to be very cautious if you just look at volume per se. You really need to break down those volume by different source, whether they are from retail side where your margins are slightly better, or from institution where your margins are much lower. You have to put on a lot more research to support the service. And the worst on will be those that are just churning, the day traders, where in a lot of stockbroking companies, they contribute a significant part of volume, but they don't pay any commission, or they only pay the net amount, whatever that's retained at the end of the day. So while the industry does look at volume as a leadership measurement, I think one should also look at profitability of the business. You could be number one, but if you're not making money, it just doesn't make sense to stay in the business. Unfortunately, for stockbroking, that's how they're being measured.
Will the Hwang Affin merger be focusing on the retail side of business, or would you start to try to attract the institutional business as well?
From what I understand, I think when Affin look at Hwang, one of the attractiveness of Hwang is really that we had a strong retail business in Penang. I think that's something that is of value to the Affin group. At the institutional side, I think the group will have to build on it. Definitely by buying into the asset management, we will provide them a small platform in terms of volumes, in terms of what we can offer to the table. But I think at the institutional side, there is probably a lot more work to be done to build a much stronger presence in Malaysia.
Some analysts also think that Affin would have to do a rights issue to fund the purchase. How quickly do you think that the enlarged entity's earnings growth would compensate investors for coughing out the cash?
It would be premature for me to comment on Affin's funding requirement for this transaction. But suffice to say that if you look at the market cap of Affin, look at the size of this transaction, they probably need to raise some capital. Whether it's through debt, equity, a combination of both, I think the group probably will be in the best position to know how to maximize the opportunities in the capital market.
Will you be moving away from fund management in the new entity or have an expanded role?
I'm happy doing what I'm doing. I've been running asset management. I've been a fund manager for more than 20 years. This is something of my forte that I've been doing, and I have no intention to move on and expand the role that I can contribute to the group. And I think the group probably would like me to spend a lot more time to expand the business to a much bigger platform than we have today. Today we are of 24 billion in size. We are hoping that in 5 years' time we can see a figure like 50 billion. Today we are operating out of Malaysia alone. Hopefully in the next 3 to 5 years, Affin would have asset management companies operations not just in Malaysia but in 1 or 2 other Asian countries. Today we are not having any marketing exposure to any other parts of the world. Hopefully by the end of 3-5 years we could have some presence in Japan, some presence in Europe, and also in Australia. So if I map out all these activities, there are enough for me to do. There's enough on the plate for me to keep me busy for the next 3 to 5 years.
You mentioned that you have a target for 50 billion AUM. You have pretty ambitious plans to go into all these different countries, including Europe and Japan and so on. What makes you think that you can, as a local company, break into these markets?
I think for Japan, it's only natural because we have a shareholder shareholder in the asset management business. Nikko Asset Management currently holds 30% in Hwang Investment Management. Post the Affin transaction, Nikko Asset Management is committed to stay invested in the combined entity, and they are also committed to help us bring some of our funds to Japan. What we need to enhance is really our capability of offering the mandates or offering strategies that are not just Malaysian centric. I think the world, when they look at investments, they look at more like Asia, Europe, US, developed, and it's a lot more broader in nature. So what we hope to offer is our approach towards investments, which is slightly unique. We run portfolios on an absolute return basis. We use cash and as a balancing item in periods where markets are volatile. We tend to hold a little bit more cash to protect ourselves. If you look at the other global houses, they tend to be a more relative way of managing money. So we think there's a small space that we can contribute and play. So far, we have done some initial work in Europe. We are working with some partners there, and we're getting some positive feedback. It's still early days. Hopefully, in the next 3 to 5 years, I'll be able to update you how we have progressed in those countries.
I definitely want to talk about your cash strategy later on, but just as a matter of talking about this expansion into Europe, there are many products over there in the West that are priced very competitively. For instance, a lot of funds are now offering management fees of below 1%, sometimes even below 0.5%. Your funds currently now are priced at higher than industry level. Are you saying that you're going to see a reduction in your pricing?
Not really. I think we are keeping to our pricing. Depending on whether it's institutional clients or clients that come through funds, it all depends. I think if you look at even Japan retail products, we can be competitive. I don't think pricing should be an issue for us. We live in a very competitive world anyway. In Malaysia, if you look at Malaysian-based mandates and the way our competitors quote, we tend to quote slightly higher. We tend to walk away from mandates when the fees doesn't make sense to us at all. And that has been a strategy and a policy that we adopt. So for Europe and Japan, during our prelim investigation, as we move to those markets during the past 1 year, we find that we can commit to those prices that is demanded from us.